Let's see.
Did you do it?
I'm just about to.
There you go.
What are we talking about today? Weight Watchers. I got that one.
Weight Watchers, Bath and Body Works, Schlumberger, Weatherford. It's a little retail oil services combo plate.
What is a Weatherford symbol?
WFRD.
And Schlumberger is SLB.
Let's do. Okay, and then we post it, and then we. Alrighty, we're now officially posted. We're X-rated, so to speak. But if that gets us viewers, let's say it. Let's say it, over and over. I don't know. Do you want to just jump in and see how it builds, or do you want to wait another minute?
I defer to you.
We have
you're the host. You can make the call.
All right. Well, I guess let's begin. Let's begin at the beginning. So today is the 8th, January 8th. We're not. I mean, we can keep saying Happy New Year to each other. I mean, that's still okay. I think we have another week of that, especially in healthcare. With the JP Morgan conference kicking off next week, there will be a lot of people saying that this is. By the way, this is I'm sure for every conference. I don't know if you guys have the same experience, but at a conference, especially a crowded conference, the same conversation happens 1,000 times. Hey, how's it going? When did you get in? Oh, isn't it crowded? Do you have a lot of good meetings, a lot of good one-on-ones? And then it's, oh, when are you leaving? And then that's goodbye to 98% of the people you run into.
Yes. There might be a what did you do over the holidays in there too.
Yeah.
Sometimes, depending on how well you know the person.
I love that when the people you really don't want to talk to, you just go, oh, it's crazy. And then you keep walking because I'm late for a one-on-one. It's crazy.
That's the ultimate conference fib. I'm late for a 101 when you don't want to talk to somebody.
Yeah, then you see them standing scrolling on their phone 20 minutes later. But yeah, my one-on-one canceled. But you're heading out to the ICR next week.
ICR next week.
Yeah, how crowded is that conference? I took a look at the website. It seems like it's hosted by every bank, so it's a multi-bank sponsored conference.
It's hosted by an external investor relations company. So that's who the official sponsor is. But over the years, they've managed to rope all these banks into more and more participation, which has actually been to the detriment of the conference. Because one of the good things about this conference was because it was not run by a bank, it had I've been going to this for over 20 years, and it used to have very democratic kind of access. Everybody presented, everyone had breakouts. There wasn't a million side meetings. But as for the IR company, they've charged the banks tons to be sponsors. And as a result, they get the right to have side meetings, private dinners, private cocktail hours with the various companies, which is, basically corporate access events. And, as a result, it's become a lot less democratic, and it's become, bigger commission payers, getting different meetings. And to me, the most annoying part of it is there are a bunch of companies that come to have meetings at the conference, but they don't even present. So actually, this is an interesting topic for years, Lululemon has come and they stopped doing meetings probably before the pandemic, around 2018, and they only do side meetings through brokers, and they have a full schedule. But if you're not paying a broker, you're not seeing them unless you see them at cocktail hour, catch them in the hallway kind of thing. Now, Nike, interestingly enough, is coming for the first time, I think, in my memory, even going back 20 years when a lot of larger cap companies came. I don't remember Nike ever coming to this conference, which, at a 5-year low or whatever it's at now, interesting that they're making this IR choice here, to get out in front of people. But they're not presenting and they're only doing meetings. And I've been saying to my friends who I've talked to about this, I think this is IR mispractice. If your stock is down more than 50% off the highs, is at a 5-year low, the people who you need to buy your stock are going to be people who are contrarian investors, often value investors. Value investors are generally lower turnover investors. Lower turnover investors also generate less commissions. The people who generate tons of commissions are the fast money pods, the Citadels, Point72s, Balyasny, etc., who also generate the most commissions. So to me, it's Nike IR. If you hear me, this is malpractice, because you want to be getting in front of people who want to bet on your turnaround, which is a 2 to 3 year story, not people who are trying to figure out whether or not you pump more Romeros into the market this quarter and are going to beat on your next earnings in March. So, doing this very highly gate kept conference attendance, I would say, is a major mistake for Nike and for Lulu, because they're getting themselves in front of the investors that aren't going to help them when they're down and out. So anyway, that's my little.
No, I 100% agree. I think you're right. I 100% agree. You can't. You want to democratize these things, first of all, just for being fair. Like, it's not fair that a large firm or a high trading volume firm just gets the access whenever they want, while a Brown Advisory in Baltimore, which is a great value investor, and they don't get that meeting right away. And it's just silly. It's like and by the way, I have no connection with them. I was just thinking of like small firm that I've liked in the past. I don't. In fact, they may be horrible. I have no idea. I just know that they were super nice, and they're like, yeah. Don't take that as an endorsement or anything. But they were super nice, and they're value investors, and they're really thoughtful. But guess what? They're not churning, and so I agree. I think that do your one-off meetings as well, but do a larger presentation with a robust Q&A and a breakout. So
yeah, it's great to me. It's one of the reasons I loved like the CAGNY conference, which is the CPG one in February, which is another one that's not banks, but that's like an analyst group sponsors it, sort of like a nonprofit, because everybody gets the same access, and also it's long-term focus that they have all CEOs talking about the years. But I just found it interesting that the IR doesn't realize that the people who were buying you on the way up are not the same people who are going to buy you on the down and out. And yeah, I mean, Nike might be better off talking to somebody who only runs $1 billion, but is willing to put 10% of it, $100 million, and stick there if they really believe in this turnaround, versus talking to somebody who's at a $5 billion fund, but turns over their portfolio 10 times a year. That's not what they need right now. But anyway.
When you go to the ICR next week, what are the things you're listening for, you're looking for? Like, what are the things that you're saying, okay, I want to take away this in order to know what's going on?
Well,
non-company specific.
I guess it's like twofold. Like, so you're seeing a conference that's got a lot of retailers and a lot of restaurants, a lot of consumer facing companies right after the holidays. So first of all, it's just going to be a bonanza of pre-announcements, right?
Yeah,
so
you exactly. Doesn't that start today? When that starts, don't those pre-announcements start today and tomorrow, basically?
They can start as early as today, but generally you wake up Monday morning to at least 4 companies moving 10% one way or another, because they pre-release between 7 and 8 a.m. on Monday morning. And so, in past years, I'm not doing this so much this year, But in past years, like I've made a game of trying to, trade like little trades around what I think is going to happen that morning. I mean, that's the same as opening your FanDuel app. Like it's not really investing. It's just like a fun thing to do for Monday morning entertainment. But because they're not big bets or whatever. But so there's two things that I, really, get out of this conference. One is, sort of you see a whole bunch of companies like in a range of, low income, mid income, high income consumer exposure. Some of them are smaller. They're, more less mature, some are more mature. You see a range of consumer companies talking about how their Christmas went and how they're planning in their year. So there's just like the overall tone for the consumer. So that's important. And then the other thing that I go for is to see specific, really small to micro cap companies, because there are a ton of companies under $1 billion market cap, and a lot of them are hard up for people to talk to. Everyone's trying to talk to Lululemon and Nike and Five Below and, the larger, higher profile companies. But there are a lot of companies that, so I usually try to cull through the list and look for small caps that are off the radar that I can, get serious one-on-one time on management. And, those are the companies that, the lottery tickets I've talked to you about before here, or like, ones that can be multi-baggers, because either they're that small because they're early in their growth journey and they're more recent IPOs, or they're just down and out for whatever reason. I was actually, I think I was talking to Robert about this like offline. I was reminiscing like the most interesting ICR I ever did was in 2009 when like everything was blowing up. And I decided I was just going to, and it used to be in California and it was outside and the breakouts were at tables. And I went from table to table, like it was like wedding round tables outside. And I went from table to table. I had a list, every company that was under $5 that was down more than 60%. I went and I had a list of questions. Are you burning cash? How much cash are you burning? If your revenues went down 10% more, how much cash would you be burning? And how much cash you have on your balance sheet and how much is left on your line? And basically came out of that and said, okay, anything that has 2 years of runway to going bankrupt if the world stays screwed up in the GFC, the global financial crisis, I'm buying those. And I came out with a whole bunch of $2 stocks that, had the balance sheet to live another day. And oh my God, it was the worst month ever after buying all those stocks, because from February to March, they just kept on going down. But most of those were like 4 or 5 baggers. So, that was the greatest ICR of all time in one way.
Why does a company like Pliable's private go to conference like this? Is this saying like, hey, by the way, we're probably going to go public, or is it no, they just go to be out there, or is it, do they have like companies like that? Sometimes they have debt and they're just not equities.
Oh, there are tons of private companies. There's a whole private day, and it used to be all of Wednesday, but now it's actually turned into a half and half conference. There are a ton of private equity people that go to this conference. So it's, and there are also a lot of bankers who go to this conference. So there is just a ton of non-public markets activity. I think JP Morgan's probably the same now, right? On the biotech side, there's probably some of that going on. But, and I mean, that's another actually interesting thing, because, there are a few people I know who work in private equity, focused on like franchise businesses, restaurants, retail and apparel. And, this is the only place that I would run into them every year. And it's, a great conversation to have, because, that they, for example, like running into a private equity person who has an investment in a coffee chain right now is really like, that would be a great person to talk to about Starbucks, right? Like, so Starbucks isn't at the conference, but, there are private equity guys who are investing in these little companies that are chomping at the bit and eating away at their business. So, it's not just the companies, it's the laterals that are, that you can learn about when you're there.
Now, are you going to see, I think you mentioned we were going to talk about Weight Watchers today. Are they at that conference?
Yes. And so that's what I wanted to bring up, was that they're at the conference. So, historically, one of the places that that, you know, this conference has been a moneymaker for the people who are willing to traffic in smaller stocks, is there are always little stocks that break out at this conference. So a few years ago, I bought this Kura Sushi it's a revolving sushi bar chain, and you know, it was like, I don't know, 400 million cap, and like basically people saw this company at ICR. They were like, wow, this thing has great metrics. You know, it's growing like a weed. It was on no one's radar screen because nobody on the street really covered it. And it was like a double that year. And I mean, I think it went up like 50% in the weeks after the conference, and then it just kept going. And it's been a volatile one. I've been in and out of it. But it kind of like that ICR that year was its coming out party. People discovered that it existed. So Weight Watchers, you know, it's been, you know, was public forever before its bankruptcy, but, you know, it spent a number of years circling the drain before eventually filing. And then it came out, you know, last spring, I think or summer, it came out of bankruptcy. And yeah, like I think Morgan Stanley and two really small firms maybe right on it. But it's not a name that is on most people's radar screen. And if you ask them, most people might not know that they have this GLP business now. So I'm not saying that this is going to necessarily be a positive catalyst for Weight Watchers, but it could be, because they're going to be at a conference that has 1,500 investors, bankers, and private equity people at it. They're not presenting; they're just doing meetings. They're doing a couple of meetings through brokers, and then doing side one-on-one meetings as well. But you know, they're going to have an opportunity to get in front of people, and so it's not necessarily going to make the stock move, but it's certainly, I would say that there is more chance of upside from them being there than downside. Because if things had gone really terribly in the fourth quarter, they wouldn't be choosing this moment to go to this conference. And they just announced that they're going to the CJS Securities new ideas conference on the 14th, which is also next week, which is one of the small brokers that covers them. So, you know, if things were terrible, they wouldn't be making their conference debut. And, you know, it's a discovery factor that it's, you know, not on people's radar screens. You know, people may be killing an hour and go see them and be surprised by what they see. So.
All right.
Yeah.
That sounds like
I think that will be good for them to get out there, get in front of some people. I mean, I think that because, you know, I pitched that in, when was it, July? Like right after they spun off, or they reorged, and you know, the reality is, I think Berna's right on the GLP-1, but you got to remember also, one of the things that's positive about the stock is next summer this summer you'll have a chance to repay the term loan, which is about $10 to $12 per share of value alone. So there's a little bit of a public LBO component to this. And so, you know, if Berna's part of it, if they start growing a bit, like this stock can work if they just can stick around this 150 EBITDA number. Like, they don't really need to grow and the stock can work. But if they start growing, then the stock's really going to work, basically, is the way I think about it.
I think that's right. Yeah, because the public LBO is, you know, they're generating cash flow, and they're taking that piece of the EV and they're moving it out of the debt EV and into the equity.
Yeah, they're equitizing it, right? They're equitizing the EV, essentially. Yeah, like a private equity firm would do.
Mm-hmm.
But yeah, I mean, you know, it's weird. Berna, didn't you say that, like, in talking to people, there's just like a negative connotation to it? You know, I've been around for a while, had that Oprah run in, what was that, 17 or 18, mega run, actually. And then obviously it was kind of a bit of a disaster until finally reorg. But they got rid of $1.1 trillion of debt, which is a big deal.
Billion, not trillion. It's not the government.
But, I mean, billion.
Yeah.
Yes, so, that's a lot. That's a lot of GLP-1s to sell.
There are a lot of fat people, not that many.
Yeah.
So.
I mean, you know, like, we just need the ever so slightest, you know, like we've seen, you know, what's happened to Hims, you know, props to David for picking that stock. We just need like a little, you know, tiny slice of that magic, and to go from like 4 times EBITDA to 5 or 6 times EBITDA would be a pretty amazing. We don't need to go to 30 times EBITDA for this to work. And it's funny because I was like thinking about, the times that I invest outside of consumer, like there's always like there's often a consumer component, not in energy, which we're going to talk about in a bit, but like in healthcare. When I get involved in healthcare, there's usually some kind of like consumer tilt to it. So the reason I've owned a Lilly and now screwing around in Novo is because of, been watching the GLP thing for a long time from the consumer perspective. And I think what you need to understand, like, HIMS is for the millennials, but there are a lot of like Gen X and boomers that need to take, GLPs as well. And this is a brand that massively resonates with them. And, I've been watching like their interactions like on Facebook, with their ads and with their posts and stuff around the menopause stuff. And, women are still engaged with this brand, like women over, let's call it like 45. This is a brand that we all grew up with. And so I think they have a shot at, there's Hims is going to be huge in this. Roe is huge in this, with Serena Williams, but they just need their little piece. And I think that segmenting wise, they could get it.
All right. So then you have Bath and Body Works. Are they going to be at this conference too? I mean, I own that one, so I'm very interested. That they seem.
Oh, you and I own it. I think Ben is out. Is that right?
IPR, did you say?
No,
I think David and I still own Bath and Body Works, and you're out. I think as of yesterday.
No, I sold it. I brought it up to Byrne. Like, here's what I think. I think tomorrow we're supposed to get the Supreme Court ruling on the IEPA, and I think next week you have the ICR, and that's a lot. That's a lot of catalyst. This stock, I bought it. Like, look, just for a full background, a year ago, roughly, I'm in a chat with Berna and Jeff, the other consumer people in the Wall Street Beats community here, or partners, I mean. And I brought it up. I was like, what do you guys think of Bed Bath? And it's 8 times. Neither of them were buying. It was at $28. So that was a good call because it got down to 15 in November when, if you think back about November, almost all these consumer names were really beat to hell. And I actually bought a basket of these because I own a bunch of bonds. So I was like, maybe they remove these tariffs and this could hedge. And again, also, a lot of them were beat up. I mean, there's a lot of beat up names in there. And Deckers, I bought Target, I bought Bed Bath. So Bed Bath had terrible numbers, and Byrne and I kind of talked it through for a little while on the phone, and who knows what's going to happen, but it seems like you basically had some improvement starting recently from a very low base, but I bought the stock. It was 5.5 times next 12 months earnings, and now it's 8.5 or 8.3 or something. So that's a pretty good re-rating. And with a business that has negative comps, I don't have any edge on what their comps are going to be. So I just kind of was like, hey, I bought it at 17 and change. And now yesterday I sold it at 22 and change, or 2 days ago, sorry. And it is what it is. Like, I'm not falling in love with Bed Bath. I just was like a nice trade. I made 30% or something like that, or a little under 30%. In whatever, less than 2 months.
Well, okay, so that's annualized. That's great. I'm still sticking with it. I figure we have we're rolling the dice on good news versus bad news, but I also always like to have something I can complain about to my colleagues. So
this is a late February reporter, so we got a little time. I'm not sure I'm going to be there for earnings, but I'm less concerned about IEPA as a catalyst. Like, I feel like I don't think anyone's sort of pricing in that they're getting their tariff money back, and everybody knows that if IEPA gets struck down, which I think is probable, that they're just going to find, Ben and I have talked about this a million times, they're just going to find other ways to justify the tariffs using other statutes. So the real question is, do they get last year's tariff spending, it's costs back? And I'm not sure that that's going to be a huge driver for these stocks. I do think ICR sentiment will be a driver, but I don't expect to hear things very different than, it's been a consistent message. Like the high end is holding up, higher income people, lower income people are terrible. And it's a mixed bag of very selective consumer behavior, in the middle. And I don't expect any surprise. I don't expect any surprises there on a macro level. On a micro level, we're going to get lots of surprises next week.
All right. So Bed Bath and Beyond, you're not throwing in the towel
Bath and
yet.
Body Works. Bath and Body Works.
Bath and Body Works. You're not throwing in the towel yet, but
I am. So one out of the three panelists are out of there. But I think I was the first one in.
Yeah, you have the best basis too, so I'm letting it ride.
It's a little easier. I got those extra $2. You know what I mean? Like, yeah. And so anyway, the other thing.
It is still 7.5 PE on a de-risked PE, I think. And the data is getting better.
I'm looking at Bloomberg right now. It says 8.3.
8.3. I'm looking at Bloomberg too. Now that's weird.
8.3 forward.
How much is the stock up? I'm on 15-minute delay. I don't pay for real-time quotes on my Bloomberg anymore.
Yeah, that's a total ripoff.
Because that makes it different.
Unless you're trading real time a lot.
What's that?
I see, so forward year, so the fiscal year 27, but really that's calendar year, right? Because it'll end at the end of January.
Yeah. I have it as
8.5 times.
That's so crazy because I see this. I thought maybe the stock price could be the difference because I see it at 22.28, which is 15 minutes ago price. And
261 in earnings is the consensus I'm seeing right here.
Oh, I see 291.
Yeah, that's for fiscal year 26. Fiscal year 27 is what I'm talking about.
Oh yeah, you're looking at 27. You're right.
And let's be clear, it's declining earnings. So again, like how much multiple do you want to assign to a company that has declining earnings, right?
Sure.
So if I have 8.5 times a declining earnings
although
business,
I think yeah. No, that's fair.
You know what I mean? I'm just saying that I was taught early on that no growth business should trade around 10 times.
Yeah. And that's kind of what I was holding out for here because I think the data is getting better. And I think,
and that's fine. Yeah, I don't really have, mine was more of a garbage value buy than it was making some kind of great call. All I knew was everybody was telling me the malls were busy and this thing got beat to hell. So it was like, hey, 5.5 times earnings. And you saw in the Bloomberg alternative data, you're seeing some pickup in the weekly traffic and some of that. So I was like, all right, this should fill the gap to put it went from 22 to 15 and now it's back to 22.
Yeah, I think
I would
definitely.
All right, well, we'll move beyond whether it's 8 or 7, not that important. But all right, well, I'm sticking around for a little while. I'm going to see what happens. I am interested in these turnarounds. So, all right. So, Bernard, do you have anything else, or are we going to go to Ben?
Let's go to Ben, and I may chime in on the energy stuff.
Yeah. So let's do a complete reversal from consumer to energy services, which ironically both Berna and I own energy services too. So we have a lot of overlap on stocks today, actually, Berna.
Yes.
Good topic. Three stocks we're both involved in. Well, she owns Weatherford, and I bought Schlumberger. I had mentioned buying Schlumberger in the show a bit back, and I think here was my thinking, basically. It was pretty obvious to me that they're going to go in and they're going to do a regime change with Maduro. I was actually just in Medellin, Colombia, over the holidays, and it was funny because I was on my phone, and then all of a sudden the Wi-Fi went out. I was like, "What the hell's going on?" And then the Wi-Fi turned back on because Medellin's not super close, but it's pretty close to Caracas, and then turned back on, and then the Bloomberg notification at the top of your iPhone comes in is like, America has kidnapped or abducted. I don't know what the hell the word was they chose, but they'd taken Maduro, and I was like, oh, look at this. And it's funny because Schlumberger was up 5% on Friday, and I was like, why is this thing up for 5%? But somebody always knows, don't they? Especially this administration.
Did you hear about the prediction markets? Somebody put a bet on whether or not Maduro gets taken out by the end of January, a bunch of money like sort of flooded into that bet on Polymarket the night, I guess like a couple of days before, maybe the night before. So people are looking at whether or not there was insider trading. And then there was also a theory that there was like a spike in pizza orders at the Pentagon, geographic area on Friday night. And that could have been what spurred the person to put all the money on the Polymarket, Maduro bet. But who knows? But yeah.
So there's some Domino's guy. So there's some Domino's guy driving a Maybach today for his delivery.
$1 million. But yeah.
But
so yeah, it's not just Schlumberger.
Yeah, so the thinking was, Schlumberger is the largest energy services company in the world. And the energy services, I mean, if you pull up like a chart since 2010, these are bad charts, right? That now are starting to look good, but like think about it, like in the peak of the shale boom in 2014, this was $120 stock roughly, right? And then it bottomed in COVID at $12, and now it's 43.50, 43.60. And I got involved at like 37, something like that. And it was just like kind of what I thought would work on this. And then, because if you think about Venezuela has 3.5 million barrels of capacity for production if you use their max output. So in 1998, they were doing 3.5 million barrels a day. They're down to like 850 now, right? And so Chavez and Maduro were not necessarily the best leaders, because in 1998, Venezuela is one of the highest GDP per capita in the world, and now it's like 90% poverty line. So the country's been pretty poorly run, right? And it's really sad, because to have that much natural resources and have your country that poor is just a sign of bad management. Like there's just no arguing about that. And so from what I've talked to and read, and they just have depleted all their energy infrastructure. And if you go back and you look at 2002 to 2008, Halliburton, Schlumberger, pre and post the Iraq invasion, those stocks worked quite well. Now the energy was in a bull market, which I don't think I don't have any kind of view that oil prices are going to be absolute rippers here or anything. I think if anything, kind of caps it. But what we talked about in our subscriber chat yesterday, Bernard was like, "Hey, I like it, but this was a multiple re-rating thing where we just went from like 13 times to 14 and a half, 15 times for Schlumberger." And so you're pricing in earnings contracts in the out years. So there is obviously, I don't think there'll be not much done in the next 6 months. So you're going to have but I don't think the story is going to go anywhere.
A lot longer than that. I mean, it could be well over a year, I think.
Maybe. But I'm just saying that Trump, I mean, it was a very funny Jon
not
Stewart.
Hitting the 26 year, I don't think.
Yeah. So, but if I put it in a nutshell, Ben, what you're saying is, look, there's nowhere else to go if you're going to rebuild their oil fields. Is that essentially it?
Yeah. I mean, I think you can go through Halliburton. I mean, look, Chevron's the only player still active there, but that's an E&P. It's a different beast. Like this is just pure play, rigs, infrastructure, all this stuff. And I think that if you think about, okay, how do we get back to 3.5 million barrels or even more? Because it wasn't like they're using any horizontal drilling down there. They're going to have to do a lot of investment, and these things can have multiple years of growth runway from the amount of investment that could be had. And who knows? You still have the wild card of Iran, which I don't know if you guys have paid attention to, but there's massive internal protests, and the mullahs might be on their way out also. And could you imagine somebody who's a little pro, business? Not those guys, basically. Another mismanaged country. And there could be infrastructure investment there as well. And
but
so
I think you mentioned, either you mentioned or I read it somewhere, which I think, though, you mentioned it, which is, look, there's nowhere else to go. And the government might actually come around and sponsor or backstop the investments. I mean, because if it has to be $50 billion or $100 billion, there is a good argument that putting a backstop to that, or at least part of it, is in our national best interests.
Yeah, I think it's in the best interest of their own country, and it's the best interest of the U.S. I mean, the one for those who don't know, like the U.S. we're the number one producer of oil in the world, but we produce sweet oil, sweet crude, and Canada, we're relying on Canada's heavy crude, sour crude, whatever you want to call it. We get 4 million barrels from them that we import over pipelines, and I think the thinking is that you can now have some of that from Venezuela. Um, in the future, right? You'll have to set up the export capacity in all this stuff, but that's where you'll get some of these infrastructure energy services companies to build all that stuff. And it takes time, to Berna's point. Like this could be 3 years of like just huge building and stuff. So, and
Yeah,
again,
you could
we'll
get
see.
contract announcements in 2026, potentially, depending on how all the geopolitical works out. I was just saying, like, I think that this is more of a late 2020, like you're not going to see it in the earnings till beginning 2027, probably in the second
Yeah,
half.
I think
Anything like
that's right. But people will price that in, right?
moves, the E is really going to move in 2028, but people will price the order book, accordingly.
Exactly. It's just a multiple. It's a multiple expansion event, right? Like we're just going to get, which I think I like better because the narrative's not going to change unless suddenly I don't know what would even happen. Like, but Trump. I mean, I don't know if you guys saw that a funny Jon Stewart piece he did, and he's like, back in the day, we used to at least lie to the people about, oh, we're liberating them or whatever. This time they kind of hit it right on the nose. Trump's like, we're going to get the. I was listening to his speech that Saturday morning, and he's like, we're going to get the oil flowing. We're going to get U.S. oil companies going. I was like, Schlumberger is going to be up 10% on Monday, and it was.
Mhm.
Right.
So they're saying the quiet part out loud now.
Yeah.
So
They're not even beating around the bush anymore, right? Like with Iraq, they're like, oh, we're going to liberate the people. It's like, I mean, Iraq's, just so everyone knows, Iraq's now near the all-time high in oil production, and it had been on a multi-decade fall from the 1980s to the low being right around the invasion in 2003.
Okay, but you both think like, hey, listen, Weatherford, Schlumberger have a way to go. This wasn't just a one-time thing. If you didn't own it, though, at this point, would you buy it here or would you wait for, well, look, the news is out. There's going to be a lull. This is going to be a 10-year thing. Like, what would you do if you didn't own it right now?
I mean, I think you can. I think you can like have a position here, and then I think you just start like getting like if you don't own any, I think it's fine to buy here, and I think you just start slowly, paying attention to it. If it has a sell off, that's where you can buy. You could sell puts against it, and buy and like if you didn't want to buy, you could sell some puts, and I wouldn't do it on a levered basis, but like that way, if it hits your price, you buy it. So or you could buy some stock and sell some puts, that kind of thing. Where if it goes down, you get filled lower. Otherwise, you're collecting a little bit of income along the way. But this has like a 7% free cash flow yield, so it's not like it's super expensive or something like that. It was 8. I think it was like 8.5, something like that, and 8.5 when I bought it. And so you had a little re-rating. But I don't know, 7% free cash flow yield for a business that seems like earnings are going to have a multi-year growth runway is it's pretty good, especially in this.
Yeah,
market.
what I like about things setups like these is that they don't have to take a deal, right? Their upside is really dependent on their deciding whether or not to do this. And so if they're in a good solid financial position now, and what I mean by that is the government's at some point going to put a proposal to them and they're going to say, hey, listen, this is what we need you to do. We want you to do. Here's how you're going to get paid. And they're in the perfect spot to say, yes, no, this is what we want. They have much more leverage than they would for a lot of other situations. So it seems pretty good.
I don't know.
Yeah,
I feel like these guys are incentivized to play nicely with the government because my understanding, I've not read the whole big, beautiful bill, but my understanding talking to people who specialize in energy is that there was a lot in there for them in terms of deregulation and things that'll spur activity. So I think they're incentivized to stay friendly with the government. But there's precedent for what's paid, what these services cost. I don't think we have a history of sort of negotiating them down to unprofitable levels. Certainly not what happened in Iraq or anywhere else.
Yeah, there's good reason to think that this will develop a lot faster than otherwise expected, given that midterm elections are coming up. And so if you want to put something in place that needs congressional approval, then maybe you want to get it done sooner rather than later. But it's interesting. All right, Ben, anything else for us? Or are we express version today?
I think that's probably good. Three stocks, or four stocks if you include Weatherford. But I think we touched on a bunch of bases. You got anything, buddy?
No, I mean, look, you talked about when do we start seeing pre-announcements in healthcare? They started in earnest today, last night, and this morning. A lot of especially the smaller companies. If you're going to be at JP Morgan next week, and otherwise known as a insider trading conference, you're going to get something out that you can talk about that will cover you to talk about your earnings and revenues and trends that you're seeing. So a lot of the bigger companies have not put out their presentations. They usually do that the morning of or the night before. But a lot of the smaller companies today announced deals or outlooks. So nice. Some nice ones that I own, like EBS had some news today. But it's been also farming, and that's a Dutch company. They had some really good pre-announcement. So some nice ones. I still own the XLV and the XBI, and then these individual companies that I just mentioned. I think that we saw a little bit of a scare at the start of the year. Maybe there was they outperformed. I still think that we're in a good spot valuation wise for most of the companies. So if I didn't own the index, I would own it here. Do I think that it's going to have the same outperformance that it had last year? No, but I think it's in a good spot. The individual companies, it's on a case by case basis. So, but with that, let's say goodbye to our 282 friends that are watching right now, and the thousands more that will watch us later. I'm David Maris, Ben Bry, Berna Barchet. It is the 8th of January. Come find us at wallstreetbeats.com or passes.com/wallstreetbeats. And we'll see you next time. Have a great day.
All right. Thanks.
Bye, guys.